Hello, my name is Robert Chote and I'm Chairman of the Office for Budget Responsibility. Welcome to this presentation on our 2018 Welfare Trends Report. The WTR is an annual publication from the OBR, and this year we're devoting it to universal credit, the new welfare benefit that's going to be paid to people of working age, replacing a number of existing tax credits and social security benefits. We're doing the report on universal credit now because the number of people receiving universal credit and the amount of money being spent on it is really going to be ramping up this year. So it's a good time to increase the transparency around our forecasts and to explain how we go about estimating the impact of universal credit on the outlook for welfare spending and for the public finances. In producing this report, we're very grateful for the help of officials across government and particularly at the Department for Work and Pensions, as well as outside experts at the Resolution Foundation, the IFS and the London School of Economics. The views here are the responsibility of the Office for Budget Responsibility, and we've come under no pressure from government or anybody else. The focus of this report is on the outlook for welfare spending, not on the impact of universal credit for the distribution of income or for measures of poverty. Those are both important, but they're for other organisations to look at. The key message to take away from this report is that on the face of it, the impact of introducing universal credit on the public finances looks pretty small. If we left the system in place that's here at the moment, then you would expect to be spending about £63.2 billion in 5 years. The introduction of universal credit would cut that by about £1 billion, so a pretty small amount, and surely not much can go wrong if you're a little bit wrong about a £1 billion difference. But importantly, that £1 billion difference is itself the difference between a much larger series of gross savings and a much larger series of gross costs from universal credit, about £10 billion in each case. So you'd only need to make a relatively small amount of errors in both those gross savings and gross costs to make a much bigger error in your estimate of overall spending. So rather than looking at the possibility of getting the number wrong by a few hundreds of millions, you could easily end up making an error of billions. So in this talk, I'm going to begin by explaining briefly how universal credit will work and how it compares to the existing system, and then looking at how we forecast the impact of introducing UC on welfare spending. To do that, we come up with an estimate of what the legacy system would cost if we simply left it in place. We come up with an estimate of what universal credit would cost if it was completely rolled out from day one. And then we come up with an actual forecast of spending over the next few years by taking into account the expected pace at which universal credit will be rolled out and the additional transitional protection payments that will be made to some people who move over to it. I'll then talk about the risks and uncertainties around this analysis and around these spending forecasts before making some conclusions. So to begin with, how does universal credit stand to transform the legacy system? You can see from this chart here that universal credit is going to combine income support and the non-contributory elements of job seekers allowance and the employment and support allowance, plus housing benefit and the child and working tax credits. Once the process is complete, universal credit will account for about 2/3 of working age welfare spending and 1/4 of total welfare spending. The main features of universal credit are as follows. The system will be administered by the Department for Work and Pensions alone in Great Britain, rather than relying on a combination of the Department for Work and Pensions, HMRC and local authorities. The new credit will be awarded to benefit units. Those can be individuals or families. The maximum award that they can receive will combine a standard element plus additional elements for children, housing costs, to reflect capacity to work, caring responsibilities, childcare costs and the presence of disabled children. That maximum award will then be reduced to reflect the incomes and savings of the benefit unit and perhaps also the impact of the government's benefit cap. For earned income above a work allowance, universal credit will be withdrawn at 63 pence in the pound, while other income will be withdrawn pound for pound. For self-employed people, they will be assumed to receive self-employment income at least equal to a minimum income floor in determining how much universal credit they receive, even if their actual income, or the income they report, is less. There will be transitional protection for those people who are moved over to universal credit at DWP's discretion, a process called managed migration. If they will get less under universal credit than under the legacy system, the difference is made up to begin with, but then that cash amount remains constant and is therefore in effect eroded over time. In order to receive universal credit, people have to sign a claimant commitment outlining a set of conditions, and these conditions will be policed by work coaches who also provide people with encouragement and help getting into work and progressing to higher earnings. So what are the main differences from the legacy system that UC is going to replace? To start with, there are no rules saying that you have to work a particular number of hours to receive a particular generosity of benefit. The practical impact of that is that UC is more generous for people in low-paid mini-jobs which involve less than 16 hours work a week. On the other hand, the universal credit starts to be tapered at a lower income than tax credits, so the work allowances in universal credit are smaller than those income thresholds. In addition, universal credit is much less generous for low-income self-employed people than the legacy system, and that's because of the minimum income floor. Applying for universal credit involves a single claim and then a single payment, so there's no possibility of partial take-up in the way that at the moment quite a lot of people take up tax credits, but they don't in addition claim the housing benefit to which they're entitled. Conditionality, the conditions in the system, will be applied more widely, so some people who are out of work, but also more importantly to the people in work for the first time, both employed and self-employed. Capital limits apply to UC. That's true in some areas of the legacy system, but not for tax credits. More people will be required to report monthly on their income and other circumstances, self-employed and former tax credit recipients, for example. And there are also no income disregards, so the amount of universal credit you get is more sensitive to changes in earnings. In the legacy system, changes of less than £2,500 are ignored. Finally, support for disabled people is going to be paid in a different way through universal credit than the legacy system, via the main entitlement rather than premia added to other benefits. So, given the new system, what is the challenge of forecasting the impact this will have on welfare spending? The big problem for us is that the administrative data we have available to us does not permit the standard forecasting approach, which is to look at the recent outturn for the amount of spending that's been done on a particular benefit, and then to say how is that likely to change in future given our forecast for aspects of the economy and other things that will affect the amount of people receiving the benefit and the amount of money they would be entitled to. For example, future outlook for unemployment or earnings growth. Because there isn't a large group of universal credit people that we can look at in order to start that approach, we have to go through an alternative one instead. And that has 3 steps. First of all, we come up with a counterfactual estimate of what welfare spending would be if you simply left the universal credit legacy system in place. Then you come up with an estimate of what universal credit itself would actually cost if you rolled the system out completely from day one. Then with those 2 bits of information, we can come up with an actual forecast for spending each year, reflecting the pace at which universal credit is due to be rolled out and the cost of transitional protection temporarily for people moved from one system to the other at DWP's discretion if that results in them getting less money. This is the best forecasting approach available to us at the moment, but it's not ideal. For one thing, it's hard to usefully scrutinise the outturn data we get telling us how much is being spent on universal credit as we go along. If that turns out to be different from what we'd expected, it's hard to know whether it's because universal credit has had a different impact, whether it's been rolled out to different people or at a different pace from what you'd expected, or whether that's simply the sort of forecasting error that you would have got producing the legacy system forecast on its own. In addition to those particular challenges, there are of course lots of risks and uncertainties around the forecasting that we'll talk about in a minute. So let's look at how the forecast builds up. This chart shows our forecast for what the legacy system would cost if universal credit was not being introduced. And this line shows the cost of universal credit if it was rolled out completely from day one. As you can see, there's a gap between the two of about £2 to £2.5 billion. So that's the steady state saving from universal credit as best we can judge it, coming up for about £2.5 billion. If you then produce a forecast for actual spending, as the number of people move from the legacy system to universal credit, spending moves from the no UC counterfactual to the full UC counterfactual. By 2022-23, we'd expect universal credit to be almost fully rolled out, and so actual spending would be pretty close to the full UC counterfactual, except that is for the cost of transitional protection, which is estimated at about £1.3 billion that year, which means that temporarily at least you're not getting all of that saving showing through straight away. So let's look at some of these elements in a bit more detail. This table shows the forecast for the legacy system if universal credit wasn't being introduced, broken down into the different legacy benefits, of which tax credits is the largest. As you can see, in cash terms, the amount spent on the legacy system is pretty flat in this counterfactual through until 2020-21, and that's because most elements of the working age welfare system are currently being frozen in cash terms. The spending then rises a bit in 2021-22 and 22-23, as on current policy this is the point at which uprating by inflation would resume. Throughout the period, though, spending on the legacy system falling slightly as a share of national income. That's because when the elements of the system are raised by inflation at most, or frozen, they're falling relative to living standards in the economy overall. Now let's turn to the steady state impact, how much universal credit would cost or save relative to the legacy system once fully rolled out. As we saw a few moments ago, the net steady state saving is between £2 and £2.5 billion a year. So what makes that up? Well, to begin with, you have some elements of universal credit that actually cost more rather than less. For example, higher take-up. In particular, this is because partial take-up of entitlement is no longer really possible in universal credit. So for those people who currently claim tax credits but don't claim the housing benefit to which they're entitled, would have to claim the equivalent of both elements if they make a claim for universal credit. Then you have the additional cost that comes from those people for whom universal credit is more generous than the legacy system. In particular, that's people on relatively low paid work of less than 16 hours a week, who in the legacy system would only be entitled to less generous out of work benefits. Then there's the additional cost arising from the fact that we've abolishing the income disregard, in other words that the universal credit entitlement adjusts to any change in earnings rather than to changes only of greater than £2,500. There are then some additional costs from higher error and fraud. Again, that's down largely to the possibility of greater sensitivity to earnings. The big savings from universal credit come from those people for whom it is less generous than the system that it's replacing. This arises in particular because the work allowances at which people can earn before they start to see their universal credit tapered away with rising income are smaller than the income thresholds in the tax credit system. In addition, there are savings because of the minimum income floor, the fact that low-income self-employed people are assumed to be earning at least the MIF when they decide how much universal credit to get, rather than the actual level of income that they earn or report. Abolishing the income disregard, of course, has effects that produce savings in some cases, and then there's also lower error and fraud. There are a number of specific features of universal credit that should deliver lower error and fraud, amongst them the exploitation of the HMRC's real-time information system, which gets regular information from employers, and hopefully that can be fed through to Department for Work and Pensions' own systems, and that will be one way of getting error and fraud out of the system. Add all of these things together and you're back with this estimate of a steady state saving of between £2 and £2.5 billion a year. In terms of the number of people actually receiving universal credit, this is our central forecast for the caseload, the number of people actually receiving it. This was about 660,000 back in November last year, still relatively small, and most of the people moved over to that were people who'd been receiving JSA, Job Seekers Allowance, rather than the other legacy benefits. As you can see, moving further ahead into the future, the other benefits become more important, and by 2022-23, when the system is almost fully rolled out, we anticipate there being almost 7 million people in receipt of universal credit. That 7 million people, most of them will have arrived on universal credit as a result of natural migration. Households will got to have circumstances where they become entitled to universal credit for the first time, not having been entitled for support before, or when their circumstances change and that changes the amount of benefit to which they would be entitled. But there's also a little over 1 million people who would be migrated onto universal credit at DWP's discretion, and these are the so-called managed migrants. As we can see here, the universal credit rollout schedule has moved quite a lot in the past. Originally, under the original plans, the system would have been pretty much fully rolled out by now, but it's been gradually pushed ahead into the future. Some of the earlier changes were down to the fact that it was realised that the initial estimates were too ambitious in how quickly the system could be rolled out. More recently, the schedule has been pushed out into the future in part because changes to the policy design for universal credit have required changes to the IT system, and that takes time to do. But this underlines the fact that the rollout schedule for universal credit is not entirely in the government's control and is an important source of uncertainty. In the actual forecast, once you see the rollout of universal credit progressing, you can see from this chart how the overall makeup of working age welfare spending moves away from the legacy system and towards universal credit as the system rolls out, and then there's a little bit of extra spending as a result of transitional protection. The cost of transitional protection rises steadily through from about 2020 onwards and would peak at about £1.3 billion just towards the end of our 5-year forecast. Transitional protection is temporary, but some people would continue to receive it well beyond the forecast horizon, and that means that there'll still be money being spent on it, but the sums are unlikely to be huge. So what are the risks and uncertainties that lie around these estimates of the impact that universal credit will have on welfare spending? We can think of them in 4 categories. There's underlying risks arising from our forecasts for the economy, the housing market, the labour market, etc. There are risks that arise from the static modelling of universal credit. That's the modelling of the impact it would have without worrying about how it would affect people's behaviour. Then there are the risks that arise from changes in people's behaviour, and then the risks that the policy will change again. Let's look at these in turn. For the underlying forecast risks, many of them affect both the legacy system and the universal credit spending, but some of these forecast risks would affect them differently and therefore the net saving or net cost of the new system. And that's particularly if they affect some groups of claimants that universal credit treats more or less generously than the legacy system. So the sort of structural features of the forecast that could affect spending include potential GDP growth, earnings growth and employment, the proportion of people in self-employment, the number of people renting their homes, and the split between renting in the social and private sector. For the ups and downs of the economic cycle, spending will be affected by changes in unemployment, in earnings and inflation, in the pace at which the national minimum living wage are rolled out, and rent inflation. All of these could affect either the number of people entitled to universal credit or the amount they're entitled to. For the static modelling risks, we're looking here at whether the forecasting architecture gives us a good guide to what universal credit is going to involve when it's fully rolled out. The key models used by the Department for Work and Pensions in estimating the impact of universal credit, the PSM and INFORM models, are based on something called the Family Resources Survey. This is a survey of around 19,000 households, and it provides the sort of information on their incomes and characteristics that we need to estimate the impact of the system. About 4,500 of these households in the FRS are relevant to the universal credit system, and that's quite a good large sample to look at a reform of this form. Unfortunately, for some elements, some groups who are gainers or losers from the move to UC, there are very few people in the FRS for whom that represents. So you might see some groups for which there are only a single figure number of households in the FRS for whom that applies. and it's not at all clear that they will be representative of that whole population when the UC is moved out. There's a particular challenge in modelling the static impact of the minimum income floor, which applies to the low-income self-employed. That's because the incomes of low-income self-employed people tend to be variable and the distribution of them is uncertain. There's the challenge that self-employment is defined in different parts of the welfare and tax system. And there's also the fact that the work coaches have discretion in actually setting the level of the minimum income floor, although the evidence to date is that most of them are being set at the maximum, but there haven't been many cases yet. Another challenge with the FRS is that it's hard to adjust for the well-known underreporting of capital and savings in the survey. Turning now to trying to estimate the impact of changes in behaviour as a result of the introduction of UC, there are a variety of issues that we need to look at listed here. The take-up rate, the impact of conditionality, responses to the minimum income floor, error and fraud, etc. Beginning with take-up rates, this is the main area where we have actually adjusted the forecast for likely changes in behaviour. The assumptions we've made include the fact that for all people who currently claim all or part of the legacy benefits to which they're entitled, we assume that they will claim all of the universal credit to which they're entitled if those awards are greater than £4,000 a year. For awards less than that, we assume that some people are deterred from claiming and decide that it's not worth it. For those people who do not currently claim their legacy benefits, we assume that 20% of employees and 10% of self-employed people will actually start to claim. There are a number of uncertainties around all of this, one of which is that you don't know what impact stigma is going to have on people's willingness to claim UC. We're going to be extending the conditionality regime, for example, to a whole variety of people who don't currently have those sorts of conditions imposed on them or who don't deal with the Department for Work and Pensions on a regular basis. Are people going to feel that they don't want to get involved in that conditionality regime, or just generally that the stigma of being a recipient of universal credit is not something they want to put up with? The operation of conditionality is a key uncertainty. The universal credit will require the appointment of 13,000 work coaches whose job it is to police the system and to help people in their search for work and the search for better paid work. These work coaches will place people who claim UC in one of 6 conditionality regimes, ranging from ones that require intensive work search to those where people are judged to be working enough. If people don't meet the conditions that they've signed up to, claims can be sanctioned. In other words, they won't be paid either in whole or part. And that can be the amount by which that is the case reflects the severity of their non-compliance and the amount of times they repeat that non-compliance. There will be an appeals procedure against these sorts of judgments, probably similar to that in the legacy system. But the role of the coaches here is key. This is a demanding role and it's paying a relatively modest salary. So when looking at conditionality, there are key questions, particularly around the work coaches, of whether the DWP will be able to hire enough good people to do the job, how they will behave in practice given the guidance that they'll be provided with, and how often their decisions might be challenged. The economic impact of conditionality is also unclear. What sort of employment will those people who are moved into work as a result of UC get? And will the successes of people being moved into work or onto higher earnings be in addition to the economic output of the economy, or will they displace the work of others? Another modelling challenge is to try to estimate how people are going to respond to the minimum income floor. As we've seen already, even estimating the impact of this without looking at behaviour is hard, but the minimum income floor will mean big falls in income for some people. Will they choose to become unemployed or low-wage employees, in which case that would raise spending, or will they raise self-employed earnings, or will they not claim universal credit at all, in which that would cut spending? This is a key uncertainty, and there are about 400,000 benefit units where you would expect the minimum income floor to be binding. In other words, that it will assume that people have a higher income than the one that they report. The potential for error and fraud is another important question. Our current approach in forecasting this is to try to map over to universal credit some of the rates of error and fraud that you see in comparable parts of the legacy system. The possibility of relatively large awards and big changes in financial entitlement could increase error and fraud, but there are specific features of universal credit that are designed to reduce it. Uncertainties around that in particular include whether the real-time information system actually works well when you get HMRC and DWP using it together, how many error and fraud cases will be processed, and how many over and underpayments will be corrected. Other behavioural responses that might affect spending include the impact of having an online service. So claimants will be able to review their accounts and report their changes online. So you might expect that to mean better information because it's easier for people to provide it. But on the other hand, maybe you get better results from prompting people for information face to face. The online service might also create a greater vulnerability to cyber attacks and the possibility that there will be less effective verification of information than you would get if people were being asked to their faces. There might be system learning, the possibility that websites will come along advising people how to navigate the system and make the best out of it, and the possibility of legal challenges, such as those that we've seen in the personal independence payments for incapacity payments, where there have been legal challenges to the way in which the guidance has been interpreted for that. Finally, there are a set of policy risks. Parliament requires us to produce our forecasts on the basis of current government policy. It's not for us to predict whether policy might change, but if you look at the history of universal credit, policy clearly can change, and it has done. The government could decide to change the design or features of the design of universal credit again, and that could mean further delays to the rollout, especially if it's the sort of thing that requires the IT system to be updated. The government might also face political pressure to limit the losses confronted by some groups. It's notable, perhaps, that some of the groups most affected potentially by universal credit are the low-income self-employed, disabled people and recipients of tax credits. Those are all groups of people for whom the government has announced tax and welfare policy changes in recent budgets and autumn statements that it's ended up deciding to reverse. The combination of forecasting changes and policy changes helps explain why, over time, we've moved from a position in which universal credit is expected to cost about $1 billion more than the legacy system after 5 years, to one now where it's expected to cost about $1 billion less, and $2 and a bit billion less if you exclude the cost of transitional protection. The big change that moved from a situation in which UC was expected to cost more money to one in which it saves a lot of money came as a result of the decision in the July 2015 budget to cut both the work allowances in universal credit and the income thresholds in tax credits significantly, but then in the November autumn statement the government reversed the tax credit changes, but it didn't reverse the changes for universal credit. At a stroke, this meant that universal credit became significantly less generous than the legacy system for a number of users. Things have moved somewhat back in the other direction, primarily in the forecast we produced in December 2016, when the expected impact of universal credit after 5 years moved from a saving of $3 billion to something closer to $1 billion. That was partly a result of modelling changes that we made. It was also partly the result of policy changes, in particular perhaps the decision to reduce the single taper rate from 65 pence in the pound to 63 pence in the pound, the rate at which universal credit is withdrawn as incomes rise. What about the evidence to date on the economic impact of universal credit? It's clear that the introduction of UC will alter both the financial and non-financial incentives people have to enter work and to progress to jobs and earnings of higher earnings. The Department for Work and Pensions published an estimate last October foreseeing a boost to employment of a little over 250,000, resulting primarily from improvements in financial incentives, but also from the conditionality regime and greater smoothness in transitions for people in and out of work. That is probably now an overestimate, as this hasn't been adjusted for the latest policy changes. DWP has also produced a study, or a series of studies, on the impact of universal credit versus job seekers' allowance as it was being rolled out, particularly in that group in 2014 and 2015. The study finds that UC leads to people having a higher probability of employment, being in employment for longer, and having higher earnings. But the department also concluded that, and I quote, additional work probably involves relatively few hours at relatively low wages. That suggests a relatively modest overall economic impact and a relatively modest impact on tax receipts. We haven't made any top-level adjustment to our forecast yet for these sorts of effects, and that's because it looks too early to be confident about what the overall impact might be. Will the impact that we see from the simple cases that have migrated to UC so far carry through to the more complex ones still to come? And will the resources provided in these early cases and the operational decisions made change as UC scales up and many more people are migrating onto the system? So finally, let me conclude. Universal credit is clearly a fiscally significant reform. Eventually, the system is going to cost £60 billion a year or thereabouts and affect 7 million benefit units. It's a complicated system to deliver and forecast because of the variety of factors that determine eligibility, the nature of the conditions applied, the particular challenges of the transition. Although in some administrative senses it will be better, notably just having to deal with DWP in Great Britain rather than DWP, HMRC and local authorities. It's a reform that results in what appears to be a relatively small net saving, but importantly this masks much bigger gross costs and savings. And that implies that there's more uncertainty around the impact on spending and the public finances than the headline comparison suggests. Those big gross costs and savings in turn mean that there are large costs and savings for some particular groups of claimants, notably for the low-income self-employed, for some people on tax credits, and for some people who are disabled, depending on the way in which the support is provided for them. So overall, the impact of universal credit on welfare spending is uncertain. It's more uncertain than the headline central estimate of the impact will suggest. So this is an important thing for the Treasury to look at and to think about in judging how best to control public spending. In all the analysis that we've done, we've been helped very much by colleagues at the Department for Work and Pensions working in their analysis teams. But it has to be said that the forecasting architecture and the architecture for monitoring the impact of universal credit as it's being rolled out is not really entirely fit for purpose. We'd really like to know much more about what people who move on to universal credit would have been receiving in the legacy system. So hopefully, when the Department for Work and Pensions puts its next business case to the Treasury and the Cabinet Office later next year, greater investment of people and data in being able to monitor the impact of the system and to be able to forecast its impact will be a good thing all round. Thanks very much indeed for listening.